Welcome to Market Monday from the investment team and the trust department at the First National Bank. We're going to get started today by looking at the XLF, which is the financial sector ETF, as a proxy for recent volatility in the banking sector. And looking at this chart, you can see that right ahead of Silicon Valley Bank's failure, this was trading up around 36 and a quarter. It's now down to just right around 31, a decline of about 14.5%. And this is largely due to the recent turmoil in the banking sector, where we had several really prominent bank failures. We're not going to go into that again. And a loss of confidence in several other lenders who have not failed, but whose stock has come under pressure. And this has caused the Federal Reserve and Treasury Department to take some extraordinary measures in shoring up the banking system. And they've done so. And these measures include backstopping all of the depositors for an unlimited guarantee of deposits at Silicon Valley Bank, and in an indirect way, offering up a similar guarantee for any other bank that gets itself into trouble. However, they've explicitly stated that that's not what they're explicitly proposing. It's just something they're willing to explore, backstopping other financial institutions if and when they come under pressure. And we think that as a result of that, along with a new credit facility that was opened to facilitate borrowing by banks that runs in parallel with the Fed's discount window, that they may in effect have shorn up the banking system in this way. Now, with that said, that doesn't mean volatility is all set and out of the water. It doesn't mean we're out of the woods. What it does mean is that we're seeing increased signs that there will be some confidence in the banking sector going forward off of this level, as opposed to continued declines. And in the broader market, the effect has been a lot more muted. Initially, the reaction was about a 6% decline that happened pretty rapidly off of the news of Silicon Valley Bank's failure. And it quickly bounced off of that 3,800 level again that we've been talking about for a long time, where, at the end of last year, all prices were congested in this area, despite us getting some news that could have and probably should have, in low liquidity conditions prevalent at the end of the year, moved the market a lot further than they did. And that was a sign that there was some pretty good buying in that area. And again, we found that when the market flushed very quickly into that area as a result of the banking issues that were coming out a few weeks ago, it quickly bounced and got back up. And now the decline is basically about 2% instead of the 6%. So it's made up about 2/3 of its losses, even as the banking system continued to show signs of stress by continuing to decline. And that is overall pretty symptomatic of a healthy market, not an unhealthy overall equity market. And you may be asking yourself, how is it that the market is managing to remain relatively strong in general when confidence in the banking system has been shaken, and we're expecting, along with basically everyone else, that there's a high likelihood of a recession this year? What does that mean? And we think that it means that there's a bullish undertone to the market. The market tends to look out 18 to 24 months in advance, and perhaps is looking out toward an eventual recovery after a recession, which the past year or so in markets that has been pretty miserable and volatile in equities, is now stabilizing and getting ready for the next leg up. So even as the news continues to worsen regarding recession, we think that the markets were probably going to remain in this tight trading range, 4,200 to 3,800, until we get some sort of catalyst, as we get more information that allows investors to get a good outlook for the future. We may actually see the market continue to go on an upward trajectory past that 4,200, even in the midst of a recession. So we're taking a wait-and-see approach before getting into that in too much depth, but it does appear that there is strength in the market, and we want to stress that. Now, coming to bonds, it's been a very interesting period. We're showing here in gold what the yield curve looked like a month ago, and this green is what it looks like today. And rates have come down extremely sharply over the past month. 2-year paper is down 80 basis points. That's an enormous move. 10-year paper is down 41 basis points, and that's another enormous move. And the slope of this inversion in the yield curve portends that, yes, it's likely that we're going to see a recession. lower term rates are going to remain high, or short term rates are going to remain high. Longer term rates are coming down, and that actually sends us a message, because the short term rates tend to telegraph what the Fed is doing. And it does appear that even though there's talk from a lot of analysts about lowered expectations of continued rate hiking and perhaps even expectations of rate cuts in other interest rate futures markets, the Treasury is not telling us that quite so strongly just yet. On the other hand, when we see rates declining on the lower end, a lot more or the longer end, a lot more rapidly than they are the shorter end, or at least aggressively, that kind of signals to us that inflation expectations are coming down, because the 10-year bond can be taken pretty much as a proxy for inflation. If you're going to invest over a 10-year period, you want to at least be compensated for inflation. So there is a risk premium embedded into that yield to account for that. So we do see contractionary forces in the economy. We do see slowing growth of inflation, not slowing inflation. Here's an important point. In terms of the CPI and PPI that came out last week, they slowed down below areas where we were expecting, and they came in a good fashion. Inflation shows clear signs of decelerating its growth, but it is still growing by a reasonable margin, and that means the Fed still has to take some action to keep it under control, even with the ongoing concerns in the banking sector. And that brings to kind of a conclusion what's going on with markets and in the bigger picture. Talking about events, these events are less likely than normal to actually be moving the markets on the macroeconomic side of things. The reason being, these banking sector concerns have been much more prevalent over the past few weeks, likely to remain that way, although the importance of that story is going to recede as resolution is achieved there. So we're watching. We get information about manufacturing activity and inventories that's important for what's happening with the economy. Confidence, in particular, is immensely important. GDP for the last quarter, we'll get a revision, and we'll get price index, the core PCE deflator, which is an inflation proxy as well. Information about how the consumer is doing with income and spending. Again, sentiment. We're going to get manufacturing information again, and outlook information over the next couple of weeks, along with labor market information. And all of that stuff is normally, at least over the past year, been extremely important. But again, we think the view on these is going to be a little bit more muted until that final resolution of the issues in the financial sector and the confidence problems that have been there. We see a resolution on the horizon, but we think that'll happen slowly. So zooming back out, in the context of a fairly strong market, what does it mean for your long-term plan? And we think, again, we don't make decisions in a long-term plan based on short-term events. We're seeing strength in the market. We know that if we're investing over 5 years, 10 years, in longer periods, which we are as disciplined, long-term, value-oriented investors, that we're going to be okay, even through periods like 2020, even through periods like the Great Financial Crisis in 07 or 08. And it bears repeating that what we're seeing now in the financial sector is not at all similar to what happened in 2008. This is absolutely not the same level of event. So we're not forecasting anything remotely like that, and we see a great long-term outlook in the equity markets, and we see good interest rates. I mean, these are the Treasury rates that are up at 3 years at 3 3/4 and 10 years at 3.5. We're seeing long-term rates that are beneficial to income investors. So we want to stay the course. We're in it for the long haul, and we're here to talk if you have questions or concerns. Hope you found this video useful. Thank you, and have a great day.